Hello, everyone, and welcome to another episode of the Stock Market Today video. It is a Friday, November 1st, which means you've got the extended Stock Market Today video today. I'm filling in for Allie. My name is Justin Nielsen. She is on vacation today. And as usual, we've got Mike Webster filling in the co-chair seat, and he's going to be going through some of the factors that he looks at and what a change in the market we saw this week, Mike.
Oh yeah, we broke the 21 for the first time in quite some time, and so it's a definite change in character. So we'll go over that and get ready for. There's a little news next week, just a few things
Right.
going on. So
Some events that might shake things up a little bit. I mean, I don't want to go out on a limb, but it's possible.
yeah,
So of course, we're also going to cover some sector ETFs, some stocks. We're going to go over some regression channel lines, breadth indicators. We've got a heck of a show for you today. So first of all, let's go ahead and go through some of the stocks that we're going to cover later on in the show. That's going to include Reddit, Netflix, and also DocuSign. But we're also going to do a quick a quick review of some of the other stocks that are looking interesting, like Google and Shake Shack. So there's going to be some others that we take a look at. But let's first take a look at the markets. S&P 500 up about 0.4% today. NASDAQ Composite up 0.8%. And let's see, the Dow Jones Industrial Average up 0.7%. Looks like the Russell 2000 also up about 0.6%. Notably, the semiconductor index was up 1.3% today. So not recovering from yesterday's ugliness, but at least it didn't get worse.
yeah. Look, yesterday's in your chart looks. I can't see everything on there, so I'm not sure what's going on there. Okay, that's a bit better, but still,
Yeah. Let me see if I
I
can.
don't know what's up with the sizing. But the break of the green line, which is the 21-day exponential that we had yesterday, is really significant. Now, everyone has their favorite indicators and favorite ways of looking at the market. And so you just need to trust your instruments. You need to know that your instrument is not perfect. No instrument is, but you want to use it if that is what you gauge the health of the market on. And one of the things I lean heavily on and have since the late 90s was the 21-day exponential, that green line there. Now, trading below it like we did a couple weeks ago, that's fine, but it recovered the next day with a nice gap because we didn't close below it. We traded under it like a week and a half or so ago, and went right back up. But yesterday we broke below it, closed below it. So that's significant. Closing in the lower half is really significant. Following a gap down, even more significant. So that makes yesterday's action really terrible, right? In relationship to the 21-day. That's just one day. Then you give it another day. So we get a bounce today that I think is deceivingly weak because we came up, it's an inside day within yesterday's trading range. So obviously nowhere near the gap from Wednesday, but that doesn't really recover that much. It's nice that we didn't fall apart. There's no reason for us to fall apart. Is in my opinion, right now, just everyone is just waiting to know what's going to happen next week because that's going to just determine so many things with the economy and more market sentiment than anything in the short term. But so people are kind of sitting on their hands. So we get this kind of weak bounce. But most importantly, we found resistance right there at the 21-day. So once you start finding resistance there, what was your floor now becomes your ceiling. That's fine. That's all technical analysis is really floors and ceilings. So that's what we want to keep in mind is, can we make it through that ceiling or not? And once we do, then we get more aggressive. And until then, you become conservative, but not bearish, but just conservative, because when you break the 21-day, especially after quite some time of being above it, it's more meaningful than if you just break it after being above it for like 5 days or something like that. Let's look at SPY as well.
Yeah, because I mean, notably with SPY, whereas at least yesterday the NASDAQ Composite did have its high above the 21-day moving average line. We often look to see, okay, is the high above it or not? SPY wasn't even close yesterday. I mean, it went through and it kept on going. Now, arguably, the Nasdaq has been the stronger index lately, and so I guess SPY maybe was a little bit more vulnerable.
Yeah, and so for the last, since July or so, that's when let's pull up the Qs because I think it's easy to see that way with the RS line just shows up a little bit better. The in July when it hit the 503.52, that's when the RS line peaked. And then it had been coming down for quite some time. And then it just flatlined. But as you've said, it recently started poking up a bit over the last couple weeks. And so it was looking like we were rotating out of the slower names back into the faster, more NASDAQ-oriented names, which was healthy and something we wanted to see. But still, let's go back to SPY for a second. With this one, this is still our leader. For a short period of time, the Qs and the NASDAQ were starting to have some outperformance, but still, this is our leading index, leading broad-based index, and it's starting to become in trouble, but it's not broken. So as you were alluding to, our high yesterday was well underneath the 21-day. And then today, let's go to the intraday on this one.
Yeah.
You can see that we rallied up to that point, and we were talking on IBD Live this morning about how that was kind of a key level that you wanted to see how it traded at that point, and it ran into resistance, and then could never get back above it. So it's just telling you the market's just not ready to blast higher yet, and there's no reason for it because we've had earnings, a lot of big cap earnings that have come out over the last week, and they haven't moved the needle in a huge way up or down. I mean, there's some exceptions, but not enough to really get the market moving in a big way in either direction. Let's go back to the daily again for a second. So that's on the positive, or on the side of the bulls not rushing in to just push us right back up through the 21-day. That's not a good thing, right? But also the bears couldn't push us back through a very logical level. If I was a bear and I was controlling a lot of capital and I was trying to make the market look as bad as possible going into an election, I would have pushed us underneath the 50-day near the close. I was, used a lot of ammo and pressed really hard to get it down there, but we still closed up on the day. So it's just telling you that we're in an equilibrium that is to the negative because we're underneath the 21-day, but we haven't broken apart. And the key level now to hold on SPY is that 50-day, which coincides pretty much with those old high, the marked highs of that last base, the 564.20 is in that same general space. And then, of course, if we go all the way back to the August 1st expectation breaker, that high, that's a level that we don't want to go under. If we go underneath that, then we get very, very defensive. But, a shakeout underneath the 50-day was probably in the cards. I mean, that's what it looks like. And it feels like the market wants to at least test that. And then we'll know a lot about how it reacts based on how it handles itself there.
Mm-hmm. You know what? There's a really interesting conversation going on YouTube Live right now. So I wanted you to weigh in because a lot of people are saying, why is it that you're spending so much of your focus on the 21-day moving average line? Everyone's like, well, I thought the 50-day is what the institutions use. And so why so much focus on the 21-day?
Oh, well, that's a great question. So back in the 90s, the late 90s, I did a really exhaustive study. And when I do an exhaustive study, I do it kind of hardcore. And I looked at every moving average under the sun, realizing that the 200-day was very powerful. Anyone who does backtesting will quickly realize that there's nothing better than the 200-day. But if you're an active trader, the 200-day is, really not something you can use because you're either way above it or way below it most of the time. And so that's not something you can use in your arsenal very often.
And that's also why we don't use like the very famous golden cross or to death cross, right? Because those do tend to be very late. You have a lot of destruction And by the way, those are often referred to as the 50-day crossing the 200-day. And, whether it's on the upside or the downside, that can often be so late in the game, whereas we're trying to figure out what can we do to give ourselves a little bit of an early edge, either on the upside or the downside.
Exactly. So after the 200-day, then I knew that the 50-day was just too slow for our style of trading. That's important. The 50-day on an individual stock holding a move for a model book move, that's different than the 50-day on an index level. And so I knew that 50 was too long, and then I tested the 10-day out a lot, as well as an 8-day exponential, and those were good, but just too short. And so after a lot of working through a lot of different things, I settled in on the 21-day after a lot of back testing. And frankly, I think it was a 33 or 34 actually gave me the best test results from a big back test that I did. But the 21-day really meshed with my own trading of when I was making money. And then I was also looking at it as our style was making money. We tended to be above the 21-day. And then in reverse, when you were getting chopped up, it was typically when you were underneath the 21-day or just chopping around back and forth with it. And that's why we really like to see the low get above your 21-day to know that you truly are more out of the woods than just a close above it. Hopefully that helps. And anyone who has questions about this should just go and study all of them themselves and put them all on the chart and see which one meshes with your style of trading. 21-day might be too short for you, or it might be too long, but it's kind of the Goldilocks for me. And I've studied it for a few decades. I've yet to find anything better.
Yeah. And so again, a lot of that does come down to your time frame. Not everyone has the ability to withstand some of the drawdowns that are necessary to come all the way down to the 50-day moving average line. And again, a lot of times we're maybe a little bit quicker. There's a lot of times opportunities ahead of that. So it's just a matter of getting some earlier signals. As with anything, the shorter your time frame, the more noise you're going to have, the more signals you're going to have trigger. And so that's the downside of these things, right? You're going to potentially get more false signals, ones that don't work. But when you get the ones that do work, they can be a little bit more profitable and allow you to keep more of the gains. And I also, as a side note, I think it's interesting that after you were doing all of that exhaustive study, I remember this must have been 15 years ago, you came across some notes of Bill O'Neill, the chairman and founder of Investors Business Daily, with a note like, how he liked the 21-day moving average line. It wasn't something that you had heard him talk about.
It was actually maybe 23 years ago when that happened, and I was going through.
It's all blending together.
his old files. And I found a checklist that said, because I had kept my 21-day research to myself because it was sacrilegious to say anything outside of what Bill had ever said. So I did the work, but it was just one of those things you just did not go there with him. And then when I saw the sheet that he had, this checklist for his old PMs, it was typewritten and it looked like it was from like probably 68 or 69. And it had all these conditions. And the very first thing was, is the Dow Jones above its 21-day or not? And I was like, I got the winning ticket. I can finally use 21-day. And then at that point, I started talking about it at seminars and such once I started teaching seminars with him. And a lot of people are using it now. And so it becomes a little bit more self-fulfilling the more people that are using it. So it always makes me happy seeing other people using it.
Yeah. So our conversation here wouldn't be complete on SPY without taking a look at RSP, which is of course the Invesco equal weighted S&P 500. This was kind of starting to show some cracks earlier than SPY.
Yeah. So this is how I like to look at breadth. Since it's a broad base, it's just the S&P components equally weighted. And if you notice here, we lost the 21-day, a week or so ago. But more importantly, this week, we lost the 50-day and the last marked low, the 176.41. Now, we closed right at that, but still we traded underneath it. So a very basic definition of an uptrend is higher highs and higher lows. And how we like to define them are those marked highs and marked lows that you see on the charts, just those numbers. And that just means that's a ninth day high on each side, or a ninth day low or more on each side of it. And it works really well. I mean, you can certainly go with an 8-day or a 10-day, but the 9 days that, that we've been using forever really seems to work. And so it's now no longer in an uptrend in a very short term sense of it, because we've undercut that 176.41. So we want to see it recover back, and then make higher highs as well as higher lows. But at this point, it looks like it might need a base build, and this is your average stock, and your average stock is now back at its 50, but not far below it. So that's okay. I mean, markets don't go straight up, but it looks like we've got a trend change here. We'll see that a little bit more clearly when we look at the regression lines.
Yeah. And it's worth noting that we had David Keller, CMT, on our IBD live show today. He used to be the chief market strategist at stockcharts.com. Now he's the founder of Sierra Alpha. And he was showing us some really interesting charts about, to your point, a number of the S&P 500 stocks are now a greater percentage are below their 50-day moving average lines. And that really kind of changed just in the last couple of weeks, from like, what was it, 80% down to, 50% or less.
His stuff that he did on live today was just great. And if you don't already subscribe to it, I would do a trial just to watch the replay of it. And I love that guy. He's so good. Can't wait to have him back.
Mm-hmm. So let's take a look at some of the sectors. We like to kind of do a little sector analysis as we're covering, covering the weekly, stock. And I'm going to go in order of the sectors that were up the most today. Leading the charge was actually consumer discretionary, which makes sense because Amazon is a huge component of this, and Amazon was gapping up. Even though it closed at the lows of the day, it was still up 6%. So XLY, not a bad day, up 1.63%.
Yeah, this is if you're looking to buy stocks, this is the pond that I would fish in at the moment, because I was going through a lot of them in that group. And there's things like Home Depot that I think David brought up this morning, and, right at its 50 days. So this is not some, high flyer stock, but at least it's in position. Meaning if we get a turn and we get back above our 21-day and you're wanting to add exposure, and you'd like to buy off the 50-day, that's one thing. And then you had in the same group, you had booking.com that it is up and out of there, but it's also showing that there's strength in that group. So it's not just Amazon, but there are a lot of, and even Starbucks, it's been a dog for a while, is nearing an area where it wants to break out. Now, I'm not saying that this base looks good, but it would just be good for the overall group and the market if that could break out of that base. It obviously has a lot of flaws with it, but I think that's a sector worth definitely spending a lot of time looking through.
Mm-hmm. And certainly it was worth noting that XLK, the technology select sector, that got a little bit of a bounce. XLK did close below its 50-day moving average line yesterday, back above it today. And, again, still quite a distance to the high from Wednesday, but at least kind of closing mid-range today.
Yeah, just not enough of a bounce after yesterday's break to say that the buyers are really there. So you can look in that space, obviously, because it's such an important part of everything. But it just doesn't seem like money is just broadly rushing there at this second.
Mm-hmm. And XLV, the healthcare sector, has been a little under the weather in terms of its health, trading below the 50-day moving average line. But it did get support around the 200-day moving average line and got back above it today.
This one is such a mixed bag that I can't say that you can just throw out the group, because there is a number of them that are set up. We were looking at Pod earlier that's reporting next week. It's a smaller company, but in the healthcare area that it looks like what market sell-off? It just,
Right.
it just shrugged it off. So you're always looking for things that are kind of disconnected with how the market is trading, because that just kind of shows that there's truly, buying demand in there. But, it's a crapshoot going into earnings. But we had the ISRG that gapped up, that is still holding. It's just not building on that move the way we would have wanted to, but it's still holding above the 500 level. And I think that's a big quality name in that space. But on the flip side, you've just got a lot of them that just are weak. So it's a mixed enough bag that I would look through all of them that are above the 50, above the 200, with an RS of 80 or higher.
Mm-hmm. And then XLC, which Meta is a big component there, and Alphabet as well.
Yeah, so there's a lot in this space that also look strong, and Google looks like it's coming up there, but we're going to touch on that in a little bit. So we don't have to do it now, but it looks like it's going out the right side of its base. So yeah, I think this is an area to look at.
Mm-hmm. And one of the areas that David Keller was mentioning today is the financials, XLF, looking like it's hovering right there at its 21-day moving average line.
Yeah, and like JP Morgan, which I think we've talked about before, it's just holding in there tight and really ignoring all of this. It almost feels a bit wedgy, but in a different way, it's wedging while the market is weak. So you can see that RS line is firming up a bit. So you've got the other ones, the Goldmans and the Morgan, and even Bank of America is looking okay. So that tells you that that's a space that you can look at, and there's some smaller ones too that look interesting.
Mm-hmm. And then in the industrial space, XLI, that's looking like it could be looking for support right at the 50-day moving average line after breaking the 21-day about a week ago.
Yeah, so an orderly sell-off. So I would certainly look there, because there probably are a number of stocks near their 50 days, and that's a good entry because you have your defined risk there. So yeah, I would certainly look through those now.
XLP, the staples, this is what you normally would expect to kind of do better if folks are getting really defensive. And certainly it's not like institutions are hiding here yet. This is still looking fairly weak.
Yeah, look at that. It looks like it's kind of forming a double bottom where this is its second bottom. We'll see if it can move up. But like you said, we don't really want this one working because that's
Right.
a bad sign. So it's like, you can keep on going lower. That's fine.
Halloween is over, Hershey's. You don't have a reason,
There you go.
So XLB, the materials, kind of a mixed bag here too, because I mean, you've got copper, you've got gold, you've got steel, you've got all these different things, and not to mention coal in this area. So what do you think here as it trades below the 50-day?
Yeah, kind of like with the XLV that you've got, like you said, it's a mixed bag. So you do have to kind of investigate this space.
And XLE, I mean, this does have a lot of weight in ExxonMobil and Chevron, but trading below the 200-day moving average line. And not to mention, a lot of turmoil in the Mideast that keeps on making, the price of oil kind of shift around a bit.
You've got to know your limitations. This one is my limitation. I mean, every time I think it's going to perk up, it sells off, and there's so many moving parts with it that until it starts trending up, I'm just going to let it. I probably won't do anything with this until it's over 95.
Mm-hmm. XLRE, the real estate area, this was perking up. It looked like it was getting support at the 50-day moving average line, even though the 10-year Treasury yield has been really on a tear lately. So surprising the real estate area with a lot of REITs in there. It looked like it was perking up, but now right there back below the 50-day moving average line.
Yeah, the correlation between those two, just that you would think would be there, hasn't been as strong of a correlation as you would have thought on a day-by-day basis. But yeah, it's undercutting that most recent area. It's only a 6% deep base. So I would still look there because those could be setting up for some double bottoms. Obviously, you don't want to be trading anything that's broken, but I still think that's a space worth looking at.
Mm-hmm. And one of the areas that's been surprisingly strong, even with the markets at highs, has been XLU, the utilities. That took it on the chin today, down 2.23% after having a good day yesterday when a lot of things were looking ugly. Today, things were perking up, and this one lost its 50-day.
Yeah. So another mixed bag where you've got the sorry for my voice. Been sick this week, and so it's impacting my vocal cords. But with this one, you finally get that decisive break of your 50 days. So if you had been trading it since July, this is where you'd definitely be locking some in at this point, because it's just a natural time for it to pause. But it is those two groups, your true utilities and then your AI related utilities. So it's almost like I wish we had two different ETFs so we could see what was really bringing this one down today.
Yeah. Okay, let's go ahead and shift over to some individual stocks. We said it at the beginning of the show. We've got some to go over, and let's start with Reddit. I do have a position in this. I bought this on October 4th, and I did hold this through earnings, but then I just was like, oh man, should I just take the gift? And I sold it at around 111. But then I couldn't stand it, and I bought it back. So I am in this one. I bought it back with like maybe a point higher at 112 and change. So a very strong move on its last earnings report. This ended up 42% on that day. And then it followed up the next day and added even more to the gains. Now, today, of course, it came in. So where does this stand for you, and how do you get in if you're not?
So first of all, huge congratulations, not just for being in it, but being recognizing making a mistake by selling it, because that's just not your style. Now, if it was your style to sell things on a gap up, then do it and then move on. But you buying it back is the most impressive thing that I've seen, because that's what you need to do, and that's exactly what Bill would have done. He made mistakes all the time. He was human, and so I mean, what a freaking great trade. I'm so proud of you. Now, for me, who's not in it, I'm sitting here going, okay, this is really good for the market. Now, I was negative about the market because we're underneath the 21 day, but that's short term. For the market's health, something like this, gapping up and holding the way it did, is very meaningful. And this is a name that a lot of people can get behind, because from the Peter Lynch thing of people trade what they know. And although I've never been on Reddit, I know people who are on Reddit or on there as much as like I'm on Twitter, or X, so you get the kind of this hardcore group of people that spend a lot of time there and really love it. And that's important to have a product or a service that people really love. People really love this one. Now it's just about how do you get in. The low from the gap up is a level of concern. What I would hope is to actually get a shakeout underneath that. If we can drift down, shake out underneath that day's low, because that's where most people are going to have their stops. They're going to say, okay, I was in it for the gap up. As long as it doesn't close below that or move below that, I'm going to stay with it. So if it shakes those people out and then reverses up that day, that's where I'm going to be, buying it, then using the low of that shakeout day as my entry. That would be ideal if I could tell it what to do. It's going to do whatever it wants to do. But we've studied enough of these that that they tend to kind of move sideways, sometimes for a week or two, tighten up, let all the buyers and sellers kind of agree at a new price level, then give you an area of resistance to buy it as from a breakout standpoint. So those are the two ways, either from a breakout, a week or two from now, or a shakeout underneath that gap up low. But great job. So proud of you.
Well, and to your point about the going sideways, our next stock, Netflix, that's kind of what it's been doing lately. I mean, you had this really strong reaction to earnings, up 11%. I mean, not 41%, but 11% is nothing to sneeze at. And it had, again, a little bit of a follow-up the next day, but then it just has been going sideways lately and looks pretty good. And I do have a very small position on this that I've kept. My wife made me buy this. Gosh, when was it? It was
was a
you know,
while ago.
yeah, it was way back here, not where I would ever buy a stock. And so I told her, fine, I'll buy you one share. And of course, she always compares like, well, how are you doing with your stocks versus how I'm doing with my stock? And yeah, so I still do have that one share for her.
Oh man, we could do a whole show on that. That's so great. So I think this is one of the best looking charts from a short term level that are out there that I've seen, because you've got the major risk behind you with the earnings event. It's not really linked with anything else that's going to be reporting that's tied in with it. Because like with the chip stocks, even if your chip company isn't reporting, there could be other ones that are going to move it. Same thing with software and housing and what have you. So this one is kind of isolated. It's its own little thing. Plus, like the Reddit, there are people who love Netflix. I said it on the show this morning. I've been a member of theirs since I think it was 98 when they first started, and I've never canceled my subscription, and I never will. I mean, it's a great service at a fair price. Not as fair as it used to be, but it's still a fair, it's still a fair price. They're getting there. But it looks great. And so this is what we're hoping the Reddit does. So if you miss the moral of this is, if you miss the gap up, don't feel like you need to chase it. Wait for it to doodle around and give you an expectation. So even going over the highs from earlier in this week, if it were to do that, that's where I would give it a shot. Yeah, the high of that day right there, which it kind of touched today. That's your expectation. Now, if we get a shakeout below that fourth day up, that day, that would be ideal. If you can get a shakeout there, maybe it even comes and touches the green line, your 21 day, and goes back up. That would be, kind of an ideal upside reversal. Hopefully, now that it's traded this far sideways, that it doesn't actually undercut that gap up low, but it could.
So before we move on to our third stock, DocuSign, let's take a look at some other earnings movers. You alluded to this earlier. Google, now this one's come in. It did undercut the low of its gap up day after earnings, but it's really just kind of filled in the gap. So is it good or bad?
It's both. So it's rounding out the right side of the base. Let's go to the weekly for a second. So when you look at this, if you've looked at enough stocks, it just looks like, okay, it needs to meander up to the 200 level, the right side of that, that base, and then maybe go pause and go sideways. And now let's go back to the daily. Now, on this, it's been a dog since, July, and it has really underperformed. You can see that with your RS line, but now that RS line has poked back through its moving averages, and it did that ahead of their earnings. So you could see that money was starting to rotate into this space, really as it was moving up the right-hand side of this space. So I think it's good for the overall market. Do I want to trade it? No. Do I think it's good that if I'm in it, what would I do? I would, if I was in it with a relatively new purchase, in the 160 range, I would use the 21 day as your major line in the sand. But really, today's low, you want it to hold that, So if it can't hold that, I would at least sell some of it by using your 21 day as your final exit, just because it's not the Google that it used to be.
And one more on the earnings side, Shake Shack, again, undercut the low of its gap up day, very strong looking day. Got support right there at 120 and a nice bounce today. So that scenario that you've been describing over and over, if it gets that shakeout, I mean, that's kind of what Shake did today.
Yeah. So this is exactly where, if I was in a buying mood, I was in a selling mood just because of the overall market. So I was reducing exposure. And if I was at all in a buying mood and we didn't have the election next week, I definitely would have bought this today and used today's low as your stop, because the bulls have made, they're making a stand here where it undercut that low of that first day. Now, you got nice upside reversal. I mean, that's textbook. Looks great. That RS line looks great. Again, it's a product that people who really dig Shake Shack, even though it's not as good as In-N-Out, in my opinion. But You can send the hate to my Twitter, but I'm right on that. And In-N-Out is better than Whataburger, for those of us out here in Texas. But
Yeah,
this
how
is
many In-N-Out burgers do you have out there in Texas?
it was the first thing when I moved out here that I looked to see where In-N-Out was. So it's like
I think you have to go to Arizona, don't you? Or
no. We've got several of them around here.
oh,
Like
I didn't know that. Okay.
oh yeah. I wouldn't have moved if they didn't have them. So, anyways, with Shake Shack, this is good because it's not thought of as the leader, but it's acting well. And the earnings, you had some solid earnings at 47%. There's some deceleration from last quarter, but still, this is from a mosaic standpoint of looking at all the earnings releases out there. You want to see more things like Shake Shack, and you want to see less things of. But pull up Microsoft and Apple just real quick. That's what you don't want to see, because Microsoft was doing what Google was doing. It was rounding out its right side. The RS line was poking through its moving averages, and it looked actually better than Google. But then you have the crapshoot of the earnings. So now the money would, hopefully flows from here into the Googles or the Netflixes of the world to help the market up. And let's take a look at Apple, since it's such an important company. And so you have the earnings, but really, not that much selling. Yes, it's underneath the 50-day, slightly, but in the scheme of things, it's really not that far. Let's go to the weekly. It's not that far from its highs, all-time highs, and it just looks like it needs to base build. So, but still, I would put this in the negative camp, obviously, because it's down from where the earnings came out, but certainly, only 6% off its highs. That's not terrible.
And really, I mean, if you kind of put your thumb over, this is a 17% deep base, but most of that has been under 10%.
Yeah.
So very, very flat base-ish looking. Again, all you need is your thumb over that one little week for its last earnings.
I just did it myself. Yeah, you're right.
Okay. Yeah, a lot of tight areas too. A lot of those you see those blue shaded areas 3 weeks tight. That's just something to note there.
So you were trying to get me to sing a Rolling Stone song, is what I know you were trying to do.
Okay.
Yeah.
So
got that joke.
Let's go ahead and go to our final stock. And this kind of proves a point that, look, not everything has earnings around the corner or done completely, and not everything is falling apart. I mean, this is just kind of like what correction, what pullback. It's, support of the 21-day moving average line. Arguably, in a different market environment, I think I would have been all over this today.
Absolutely. This is an ideal entry point from a swing trade, especially as it was taking out yesterday's high and then then Wednesday's high, as it got supported the 21-day. For those folks who were asking about the 21-day, earlier in the session, just look at stocks like this. It's a natural place where they find support. They don't always find support at their 10-day, and if this were to come all the way into the 50-day right now, it would look very weak. So a 21-day is really kind of your sweet spot. And now your expectation is that it continues higher. And I would use my stop as today's low as well as yesterday's low.
Mm-hmm. Now, of course, DocuSign during COVID, it was, the darling. And I mean, this is not normally what we see, stocks that come down this much. It usually is like they're done, but there are a number of these stocks that are starting to perk up again after really an ugly move.
There are a lot of them that we've written off. Pull up Twilio. I think that was one of them that I noticed this week that is coming back from the dead. So there's a lot of these, and there was I think Zoom had tried it. So I'm going to be what I think David brought up, like Peloton was trying to bounce off the bottom or something. So that one obviously looks much weaker. Forget that I brought that one up. But let's go back to the Twilio for a second, because this was a very important stock, and it had a couple moves in there. And when Charles Harris and I did some research on stocks that have led that came back to lead again. It was a very small number of them that did that, but there are some that do come back and have another model book move, and some of these will. We just don't know which ones are going to be the ones. Let's go to the daily on this one. So, a lot of, is holding in tight, so you could see that the market liked it even before the earnings. After the earnings, they love it. So it's kind of like the Reddit. It's, the second day of the Reddit move, and we just want to see if it can, go sideways and hopefully do what Netflix is doing and give us a chance to get in this one.
Mm-hmm. Another one, by the way, with some nice follow-up after its initial gap up. So there have been a lot of stocks that did not look like that after their earnings, where they had that really strong gap up and just no follow through. So very interesting. Mike, let's go ahead and turn our attention. There's a number of things, again, that we do for our extended Friday Stock Market Today videos, where we're going to take a look at some of your areas of interest. And again, since this is kind of wrapping up the weekly action, maybe we could start with the weekly chart and kind of what this is telling you in terms of some of our indicators of strength.
Yeah, so we always like to take a step back and look at, instead of, on an intraday basis or a daily basis, look at it on a weekly basis to kind of see where you're at. Is anything materially changed? Does it look broken? Is there a character change? And lots of times you can see that on the weekly. And to me, this just kind of feels a lot like it felt over here in late July, as well as over here in early April, where it just needs some more time to come down. Now, hopefully it doesn't come down as much as it did in April, or in the July-August timeframe, but it just seems like it needs more time. With that said, we obviously have the big news event next week that is going to, dictate which way we go. So at some point, it's kind of like using technical analysis going into an earnings result. It doesn't really matter because the news is going to drive what's going on. But you're still trying to look and see how is the market handling itself. And really, this is a bad candle. This is the definition of a bad candle, of widespread closing lower than where you opened. So your open was up here, your close was here, you traded a little bit lower midweek. So that's as bad as a candle, or that's a bad candle. It would be worse, obviously, if it was a bigger bar. And now on the NASDAQ, it's a bit different because it's kind of like in a way an outside candle. It just depends on your definition of looking at outside, whether it's the close above, below, and all of that. But still, it traded above last week's high and traded below last week's low, and in a negative fashion. So this feels like it needs to either go sideways or down, but we'll see. So that's what we wanted to do there. I did want to focus some time on this regression. Because this is kind of where we'll just focus. We'll go quickly through the other stuff. But here's our regression on SPY, and we're again using the August 5th low as our first anchor point. Then we're using our second anchor point out on October 14th. And I'll just blow this up.
And October 14th is being chosen because that's 50 days out. So you just kind of you keep moving it along, but then at 50 days you stop, so you don't start distorting your trend too much and follow, distort it to kind of data fit, basically.
Exactly. And so you can see with the last time that we broke through our solid line on here, which was on July 24th. And when that happened, it really needed to find a new trend. Now, that new trend could have started that next day, or it could have started when it did. But you don't know and you can't predict. You just interpret, and you're saying, okay, we've been in this trend since August, and now we are outside of that trend by definition of using, if you use this, and this is one of the things I use. So yesterday we closed decisively below that, and now today we bounced up against it at one point, and then close well underneath that -1 standard deviation, which is your your solid green line. How I like to use this, and I'm still in the steady work of this because I'm getting, really into using this indicator. And really, if we can make it back through the minus 0.75, which is this dash line there, that's when I'm going to gun it hard, aggressively, with the assumption that we're going to try to mean revert back to your white line, which is your line of best fit or your regression line. So this is something, if you don't study it, I would suggest, putting it in your toolbox. Don't use it until you understand its strengths and weaknesses. It's not perfect, but how I like to use it is saying that now we are broken from this trend. In the very short term, if we bounce back up in there, we can restart that trend. But if not, we just have to wait for a new trend. Doesn't mean we fall apart. It doesn't mean we don't go higher, but that trend is kind of done if we can't really over the next week get back up into this space. Now, NASDAQ looks
now, before you move on, I got to ask the question because it just so happens that on YouTube there's a little conversation going on, and by the way, everyone is saying, okay, yes, the market so important. It's one of the pillars of our IBD methodology, but let's say we get back above that green line a day or two before the election. I mean, how aggressive do you get right before an event like that?
Oh, that's a great question. And that depends on how aggressive you are as a trader. Unless you're in a super aggressive trader, really, with what we've had this week, I would still stay light into that because we've got, it's really Tuesday night, that we don't know how that's going to play out. If that's going to be one of these things like the hanging Chad thing where it goes on forever, or, we know that night who wins, or if it drags on. So I can't conceive of what news would push us up there before then. But if we did, you'd have to use it as a signal. I will use it as a signal, but knowing that you've got this major gap down risk, with an election result that the market's not happy with. I mean, you might be happy with it, you might not be happy with it, but it's really from a stock trading standpoint, is a market happy with it? So that is, it's just like looking to answer that question would be the same thing as on an individual stock a day or two before earnings.
Right.
If, it does something that gives you a buy signal, but it's a day or two before earnings, you might still act on that, but you're not going to act on it in the same way that you would have if you didn't have that earnings. If you didn't have the earnings, you would just gun it completely. So with this, I was talking more from using that indicator and with the assumption that we would be going through that after we knew, after Tuesday, even if it's we don't have the results, but we know at that point, like, oh, okay, all these states are here. And so people can kind of figure out this is where the Senate this is how the Senate landed in Congress, and we're just waiting on the White House. So it's
at least more data points.
there you go. And I'll look at the composite just briefly, just because this wasn't the one that we were focusing on before, because SPY was the leader. This is in a bit more of a gray area because you didn't break the trend, but you didn't decisively make it back through your 75 standard deviation there. So really, that one is a bit of a wild card. Now, what is concerning to me is RSP. And this one, and again, this is the equal weight of SPY, decisively broke. Like you would have to say this trend is dead at this point. So even if it were to move back up into this area at this point, it would be very hard to say that this is regaining that same trend. You are going to have to kind of start a new trend. It's really on the borderline, like one or two more days under here, and it's definitely, like you've got to start fresh. But I guess if magically it was up 2 or 3% on Monday for some weird reason, you can make an argument that the trend is still intact, but I would say very, very small probability.
Yeah. So again, You can't count it out completely, but you got to look at the probable versus the possible. And while it is possible, it might not be that probable. So
Yeah.
what about retracement? Every week, this is something we do on our extended stock market day video. We look at the 50% retracement levels, and just levels in general on the indexes. So what is that telling you right now?
Yeah, so just to make this quick, well, you can slice this many different ways, but using the October 17th high and yesterday's low, the midpoint there is the 577.28 on SPY. So that's where it's not a magical level, but that's just from using those areas. If you're in the lower half, you're in a weak position. You're in the upper half, you're in a strong position. And so that kind of coincides right with your 21 day. So it's just another way of saying that, how important that 21 day is. And with the NASDAQ, that midpoint there of its 50% retracement using Wednesday's high and Thursday's low is essentially the high from yesterday. So the 18,434 is a level you wanted to get above. And of course, then at that point, you'd be above your 21 day as well. I'll just toggle over to the levels real quick. I mean, pretty much the same things that we've been talking about. There are a million different lines you can put on here. In fact, I had a whole bunch more on here earlier, but I've removed them. This level here, which coincides with a lot of different things, is the high from September 26th, that 574.38. And that's kind of around yesterday's high and today's high and around the 21 day, a little bit below that you wanted to get back above there. You wanted to stay above the 565.27, and of course the 50 day. And that is your, recent low from October. And of course, our kind of line in the sand is that August 1st high there, the 554.87. And briefly on NASDAQ, kind of similar levels there. And again, with this one, I would use your key level is your August 1st high. And we'll wrap these up with just one last look at the simplest chart that we look at on Fridays. And this is just the ETF with the 21-day moving average on there and everything else stripped off, just so you can focus on the low versus the 21-day, or in this case, now your high versus the 21-day. So now that your high is underneath your 21-day, in my book, you play defensively until you can get back above there, and preferably your low above it. And now with NASDAQ is in a little bit better position because at least it's traded through its 21-day for the last couple of days. Its high isn't stuck underneath there, but we'll see how long that lasts. But still, we want to see that low get above the 21-day.
Yeah. Okay, so now we can go ahead and shift gears real quick. We'll bring this chart down and give you a chance to kind of bring your other platform up, because one of the things that we always cover is and this is going to be quick this time around because we cover the Webby RSI, not the relative strength indicator that you might be used to if you're into technical analysis, but the real simple indicator, just kind of looking at where you are in relation to that 21-day moving average line. And again, this one's going to be quick because when you're below it, that kind of changes the way you look at things. So go ahead and if you could real quickly go over your Webby RSI.
Well, there's nothing to go over here. So again, and that's kind of why we like to keep it that simple. And it is a reminder to myself that, okay, even if you look at an intraday chart and it looks like, oh, we're going to start going, hey, where are you really in the trend? And until you start seeing some blue bars up along the bottom here, that is your distance from your low to your 21-day. Right now, you've got some orange bars on there, and that's really measuring your high versus your 21-day. And so you don't want to see orange. Orange is really should be red, frankly. And so that's bad. And now let's just look at the other indicator. And this is the off high indicator. And this is measured in ATRs, average true ranges. And the blue section is for ATRs. And that's kind of what I've found is kind of normal. Every stock and index has its own feel, and that's why we have the line on there, but at least the colors give you a general sense of, if you're in green, you're still kind of in the good area. You're in yellow, cautionary, and then of course if it gets into red, then you've got some trouble ahead. So with this one, what I like to do is look at prior pullbacks and how many ATRs off your high did you get. And in this one back here in May, you can see that on May 31st, you got to just shy of 3 ATRs off your high at that point. And I used the low on there. Then we had a major, a real pullback in here down there where it was 7 ATRs off your high. But for these minor ones, then this one was about 3.5. And right now we're just about at 3. So how do I read that? That it's still in the normal territory of a normal pullback. That once it starts breaking below this one here, so if it gets more than 3.5 ATRs off the high, then I'm going to start getting more concerned. And let's just look at the Nasdaq briefly. This one, of course, is looking a bit better. It's we're seeing that divergence in the move kind of shifting over here, and this is holding up better than this pullback over here that was 3 ATRs off its highs. And of course, prior to July, this was so strong that it was just staying so close to its highs that this really wasn't an issue. So that's how I like to look at that. And one last one we will look at is the RSP on here, because that one is changing character a bit and getting underneath the pullback that we had here on September 11th. So it's right back just a little bit worse than that. So it is telling you that your average stock is getting hurt more than what you're seeing on the other index.
Yeah. And look, pullbacks aren't fun, but there's the difference between a normal pullback and something that gets a little bit more abnormal. And we're starting to approach that, more serious, range for RSP. So definitely worth keeping an eye. And as always, we're going to be keeping very close track of all of these things. If you aren't, as Mike said, if you aren't on IBD Live already, definitely check us out. You can go to investors.com/IBD Live and join us every day. Every day the market is open. We don't do weekends or holidays.
Saturdays sometimes.
Right, exactly. So we start though, 10 minutes before the market opens, and we go for a full 100 minutes or more. And sometimes if we've got a great guest, those can be even longer. We do take guests from all over. Mark Minervini's been on, Jim Ropel, some of your, O'Neill following favorites, that we have, as well as, we had David Keller on today, some really great guests. So definitely check it out there if you haven't already. And if you want to check out some of the podcasts that we have, Investing with IBD, I had Don Vandervoort on this week.
Don is great.
Yeah, Don is great. We've had him on IBD Live a couple times, and he has an IT background, and then he's like, you know what, I really like this stock stuff. So he approaches things in a very interesting rules-based way. He loves his spreadsheets, so we went over that. You can take a look at David Keller from earlier this month, as well as Mark Minervini. So yeah, a lot of great guests on that IBD podcast, Investing with IBD. All of that's available on YouTube, the podcast side. So, and of course, there's the Stock Market Today video. So Allie will be back in the chair next week on Monday. I'll be joining her. So we hope you tune in for that. Have a great weekend, everybody. We'll see you next week.